All right. Hello, everybody. Hope you're all doing well this Tuesday. The market is kind of on its heels a little bit, but really kind of schizo today, back and forth and back and forth. If you can hear me, please let me know here. Where is my chat over here? There we go. Hello, Ron, Steve. Wonderful. Come on. Let, welcome, welcome, welcome. First thing I've got to ask everybody is please smash that like button, guys, before you do anything else. Smash that like button. We got to get that up there. All right, great. So this new streaming service we're using is working well. Okay, great. So again, looking at the markets today, we're off the lows of the day. S&Ps were just down nearly 55 points. They're down 40 now. We've seen some really pretty big swings in a very short amount of time today, where we've seen S&Ps move 15, 20 points in literally a minute or two. But kind of the overriding theme is the eco data that has come out that we got this morning between ISM manufacturing and then the JOLTS number ahead of Friday's jobs number, that was a really, really strong number. So that JOLTS number especially is very indicative of the jobs market, of the employment market being really strong and healthy, which, we want to have a strong employment market, right? But the Fed doesn't want to see that in terms of interest rates because uh, they're not going to be cutting rates if the employment market, if the jobs market remains as strong and healthy as it is. So we're seeing yields tick even higher. The 10 year, as I'm looking right now, 10 years up at almost 4.7%. If you think about it, when the Fed first started cutting just a few months ago, the 10 year was trading about 3.6. It's now 4.7. So the Fed has cut rates, but interest rates are moving higher. So there's a pretty big disconnect out there right now. All right. So let's get into it. Okay. We talk about the Greeks very often, delta, gamma, vega, which is what we are going to talk about today. And if I could there we go. Not that kind of Vega. I'm not sure if any of you ever had one of those. I thought those cars were actually kind of cool when I was growing up. Not sure if any of you had a Vega back in the 70s there. What's up, Paul? How are you? How are you? Can everybody see the presentation on the screen now? You had one, huh, Vincent? All right. Did you like it? Yeah, they can be made to run. That's for sure. There's no question about that. So we're not talking about that kind of Vega, though. We are talking about option Vega, one of the Greeks, obviously. And it's so important to understand Vega. Okay. It is actually imperative. The way that I teach trading is obviously when we put on a trade, we want to get direction right, right? If we're bullish, we put on a trade that's bullish, we want the stock to go up. If we're bearish, we want the stock to go down. But for me, the holy grail is combining direction, which is really, if you think about Greeks, direction is delta, okay, with volatility, which incorporates vega. Okay, so that not the Pinto. I gotcha. No, that was a Vega. That was not the Pinto. That was a Vega. I'll find a picture of a Ford Pinto here. Let me see if I can get one really quickly here. That was another debacle, especially if you guys remember. For those of you that are as old as I am, when I think there was a story that a Pinto got hit in the gas tank or something, right? And exploded. I'm not going to blow this thing up here, but this is what a Ford Pinto looked like. Okay, that one was kind of ugly. The Vega actually had a little look to it. Anyway, here we go. So we need to understand Vega. Vega can tell us a lot about market sentiment. Okay. We use Vega to help determine which options we might trade. We have to understand Vega's impact on option premium, what it does to, how option prices change. Okay. There are absolutely different scenarios and different strategies that we use surrounding Vega depending on market environment. Okay. And we have to use Vega to adapt to changing market conditions and trading strategies. Okay, there we go. Thank you, Coop. Appreciate that. Appreciate that. So let's dive into this, okay? Market sentiment, is it doom and gloom? Is it a buy the dip, sell the rip? How is the market trading? So, for instance, right now, okay, I don't know how many, what you guys all think of the market. To me, I think right now, not that we're going to sell off, but right now the market is, the sentiment out there is, I'd say, a little bit pessimistic, not optimistic, pessimistic. To me, in a pessimistic marketplace, we typically see vol go up. We need to be very, very aware of Vega. So we have to understand, do we want to be long or short Vega? Or do we want to be neutral? Because there are plenty of times and plenty of strategies where we can put on a neutral Vega position, meaning that, boy, if we're really unsure what volatility might do, okay, then let's put on a position where volatility is not going to affect the trade. Okay, how does a Vega position affect the P&L of our overall position? And then different strategies for different trading climates. So those are all super, super important. Okay. So this is just another slide like that just kind of details really the things that we need to understand about Vega. All right. So what is Vega? And before I go into this, how many of you actually not just know what Vega is? Because if you've been trading, I'm sure you know, but really understand it and really how it affects our trading. Give me a little note in the chat here, okay, and let me know if you really feel like you understand Vega. Okay, Guillermo, thank you for your honesty. Appreciate that. Need some help, Ron? Okay. I think most traders, most day traders, most retail traders like we all are, you kind of know that Vega has something to do with volatility, but really probably don't know how to employ it or use it to your advantage. So let's go through this here. Okay. Vega is one of the Greeks and it measures an option's sensitivity to implied volatility. And the way that I teach people and in that I feel that it's easy to remember what Vega is when you're talking about the Greeks, V and V, Vega volatility. Vega is related to volatility. And what it is, it's the change in an option's price as implied volatility changes 1%, 1 point. Okay. And so if you look on your platform, okay, whatever platform you're using, Thinkorswim, IB, whatever it is, you're probably going to see the Vega calculation, okay, with decimals. Okay. That's okay. But we really refer to it as a percentage. So if you see Vega is 0.14, which is 14%, we would just talk about it and say, hey, Vol is trading 14 right now. Okay. That's the way that we reference volatility and then what the Vega is. So don't confuse though volatility with Vega. They're two separate things. Even though they're interrelated, they're intertwined. Okay. Volatility is either historical, okay, which is what has happened in the past, right? How has this stock traded in the past? Or the expected, what I call bounciness of the underlying. Okay. And that is what is the implied volatility, where we're kind of predicting what's going to happen in the future based on what's happened in the past. And that's what gives us our implied volatility levels that we look at on a daily basis to reference whether an option is cheap, expensive, or kind of fairly priced based on volatility. Is Who 14%, that is just, I'm using that as an example. One thing we're going to learn is the vol in one stock really has nothing to do with the vol in another stock. If you look at Apple and you say vol is 20%, okay, that's pretty normal. You look at Nvidia and you say, okay, vol is 40, 45%, and that's normal for Nvidia. So, to just reference and say vol at a number, you have to be specific. What are you tying that volatility to? Okay. Now, really important. Unlike delta, where call deltas are positive and put deltas are negative, VEGA is the same for both a call and a put at the same strike, same expiration. Okay. If you're long a call, you're long VEGA. If you're long a put, you're long VEGA. If you're short a call, you're short VEGA. And if you're short a put, you're short VEGA. Okay. So let's look at a quick example here, and then we're going to look at some real market stuff going on right now. Let's say the value of an option is 7.5 bucks, okay, and the implied volatility is 20. Again, meaning that's 20%. Okay. And that option has a vega of 12. That means for every 1 point that implied volatility moves, the value of that option is going to change by 12 cents. So if the implied vol jumps from 20 to 21 and a half, up 1.5 points, the value of that option is going to change by 12 times 1.5, or 18 cents, and move from 750 to 768. Okay, does that make sense to everyone? Okay, just like the delta of an option helps us measure how much the value of that option is going to change as the stock moves $1, VEGA helps measure how much the value of that option is going to change as implied volatility moves 1 percentage point. Okay, some characteristics that we have to really understand about VEGA. They're not difficult, but we just have to understand them. Okay, at the money options have the highest VEGA. Okay, so VEGA is the highest when the underlying price is near the option strike price. That's at the money. VEGA goes down, decreases the closer and closer and closer you get to expiration. So a change in volatility affects an option that is further out in time than when you're close to expiration. And thus, the more time you have to expiration, the more VEGA there is, the more sensitive that option is going to be to a change in implied volatility. Okay, does everybody understand this? And one of the reasons that, in at least in my rooms, that we trade typically very short-term expirations, whether it's a week, maybe 3 weeks. I think pretty much the max we usually ever go out is like 6 weeks or so. The reason being is I don't want to have the VEGA risk out in time. I can control VEGA risk as it's closer to expiration. And that VEGA, because it increases the further you go out in time, because it's more sensitive to a change in volatility the further out in time, I don't want to have that risk. We got enough other stuff to deal with. Okay. So that's the reason why I like to keep our trades pretty close to the vest timing wise. Okay. Now, let's look at, and you know what? I'm going to actually pull in live charts. I just did this just 10 minutes ago. This is NVIDIA, but I'm going to pull in live charts instead so we can compare and look at Vega both from where the strikes are to where the stock is, and then also time. Before we do that, though, guys, let's get our word of the day out there. I bet there's nobody here that could have guessed Chevy would have been the word of the day for the wheel. No chance. I'm sure you were all thinking Vega, the car, maybe volatility implied or something. Wanted to give you a little bit of a curveball, and Chevy is our word of the day today. And if you put Chevrolet up there, doesn't count. Okay. Chevy is our word of the day. Okay, give it another minute or so here. Let's see what the market is there. All right, so SPOO's rallied from down 55. They're down 37 right now. We put out a signal to actually buy some NVIDIA. We didn't get filled. The stock has rallied about a buck. Since then, we did get long in Dell. And I believe we did get long in GitLab, GTLB. And we were able to hedge very, very nicely our QQQ put position that we bought yesterday. Qs have moved down considerably. Volatility has gone up, made options more expensive. We were able to sell a downside put spread against our long put spread. Okay, let's get back here, guys. So I am actually going to, excuse me, bring in, let's get this over here. Bear with me. Come on, I don't want that. I only want this. Okay, can you guys see this on the screen now? This is a live option chain in NVIDIA. So if we look at things that, if you see things that are moving here, this is a live stream here. Okay, everybody see that on the screen? Wonderful. Okay, so let's take a look here. Okay, NVIDIA right now is trading 143, basically. Okay, one of the things I pointed out was at the money options have the highest Vega. Okay, let's prove it. Okay, here's our 143 strike. Here is my Vega column. Now, remember what I said, that Vega is the same for both a call and a put at the same strike, same expiration. So my layout up here where I have my Greeks, Delta, Vega, okay, and then my bid and my ask. This is the call side here, but you'll notice on the put side, I don't use Vega. Okay, I do that just so I can have more real estate on my screen, and I don't need to because Vega is the same for the call and the put. Okay, so if we look at the 143, okay, here's my Vega, 5.27. Okay, what does that mean? That means that for every 1 percentage point change in implied volatility, the value of this option will change by basically a nickel. Okay, 0.0527. So that 5 that you see, 5.27, that is actually 5 cents, 5.27 cents. Okay, so if vol were to go up 10 points, the value of that option is going to go up by about 52, 53 cents. Vol goes down 3 points, the change in the value of that option is going to go down by 15 cents or so. Okay, does that make sense to everybody? Okay, good. Good. So if we look at the option chain and look at the Vega numbers here, okay, as we said, at the money has the highest Vega. it has the most sensitivity to a change in implied volatility. And then the further we go away in either direction, the lower and lower and lower that Vega number gets. So a really far in the money or a really far out of the money option really doesn't get affected by volatility, and it has very little Vega. Marilyn, back in the house. It is great to see you, Marilyn. How the heck are you? Missed you. Okay, so these are options we're looking at right here that expire this Friday, Jan 10th. So we're getting closer and closer and closer to expiration. Very little Vega. Okay, let's go out a couple weeks. Let's just go out a couple weeks and look at the exact same options. So now we're looking at January 24th options. Okay, still going to look right at the money here. Look how much, literally in just 2 weeks, the Vega changed. The sensitivity to a change in implied volatility. Instead of 5 cents, it's now about 12 and a half cents. Basically, it's 2.5 times the amount. So a change in vol is really going to affect those options 2 weeks out a heck of a lot more than they're going to affect today's option or the options expiring this week. Okay, and again, doesn't matter what expiration you're looking at, it's always going to be the case where the at the money option is going to have the highest Vega. So the further we go out of the money here, or the further we go in the money there, you can see the Vega number reducing, decreasing. Okay, now let's go out. Let's take a look here and go out to, I'm just going to choose April options. Okay, here's NVIDIA April at the money's right here. Now we're up to about 30 cents in Vega. Okay, so going out 3 months, that Vega increased about 6x from a nickel to about 30 cents. Again, you'll see the pattern. Lower Vega, lower Vega. Okay, does everyone see the pattern? Does everybody understand? And this is critical. It's really critical, guys, when we're trading, that Vega is the highest at the money. It gets lower and lower as we get closer to expiration. And the further out in time we are, the higher that Vega is, the more sensitive that option is to a change in implied volatility. Okay, now once we really understand these characteristics and concepts of Vega, then we can kind of think about it and bring them into how we trade. Is there a time where I intentionally want to have a long Vega position or a long vol position? Is there a time where I intentionally want to have a short Vega or short volatility position? Okay, and the answer is yes. The answer is absolutely yes. And that all comes down to understanding that implied volatility is always mean reverting. Okay, so this chart that you see now, this is a live chart in NVIDIA again. This is an implied volatility chart over the last year telling us what percent the range in implied volatility has been in NVIDIA. Well, we can interpret this and look at this just like we would a stock chart. It gets down here, you want to buy it. It gets up here, you want to sell it. It's that easy. It's literally that simple. I want to be long Vega when the implied vol is super low because historically the odds show me there that more than likely that vol is going to start going up. If vol goes up and I am long, I own Vega, the options are going to start increasing in price. Don't get confused with being long Vega, okay, as having a long or short delta position. Because remember, long Vega just means you're long an option. You can be long a call or a put. So you can have a long Vega but a short delta position. You can have a long Vega and a long delta position. Okay. Likewise, when vol gets up here, we would rather sell that volatility. We would rather have a negative Vega position because, again, historically looking here, the odds are that vol is going to start trickling down. This is what is known as implied volatility being mean reverting. Let me put up another stock here and we'll see the same thing. I just happened to put up Tesla. Okay, here is Tesla. We get up here, you want to sell it. We get down there, you want to buy it. Every stock or index that you trade, you're going to be able to tell whether, just at a quick glance, whether premium, option premium, volatility is cheap, expensive, or kind of just, right where it should be. Okay, I think we just put up a last chance here. So let me just put this up here again, because then I want to go through scenarios with everybody of when it's appropriate, what kind of strategy you want to put on to take advantage of not just delta direction, but volatility, Vega as well. Okay, there's your last chance, everybody. The wheel is, I think, being constructed as we speak. Oh, I should keep going and going and going. S&Ps have rallied about 20 points since I started here. Okay. Check this out, everybody. Check this out. Okay. This is a very basic trading strategy matrix that I created. Okay. You're not going to find this on YouTube or Google or on the internet anywhere. But I have created this. This combines both direction, so whether you're bullish, bearish, or neutral, with the type of position you may want to put on depending on where volatility is. So for example, let's start in the bullish column. Okay. If we're bullish and we put on a spread position, sure, we can buy a call spread, we can sell a put spread, all sorts of things we could do. We could buy a calendar call spread, all sorts of things. This is going to detail to you some suggestions of what you may want to do. Now, this is not the end all be all, but what this really covers the strategies that we use. Okay, there's an endless amount of strategies, obviously, that we could put together. This covers the types of strategies that we use. Okay, as we said, if you want to be neutral, because let's say, let me bring back a volatility chart here real quick. Okay, let's say, and this is, I got Tesla here. Okay, here's the Tesla implied volatility over the last year. So we know we want to buy it when it's down here. We know we want to sell it when it's up there. But what if it's trading kind of right in the middle here? What if it's right in the belly, right in the sweet spot, right? Well, we don't know if it's going up or down from there. Just like an option that is at the money that has a 50 delta, So it's got like a 50% chance it can go up or a 50% chance it can go down. Kind of same thing in here. So if you get into a position where you see the implied volatility kind of right in that midstream there, doesn't mean you can't trade. It doesn't mean you can't take a directional delta position. You sure can, but you can construct your strategy, your position, so that the option VEGA is neutral. So that when there is a change in that volatility, whether it's higher or lower, whatever it is, that won't matter to your position. Okay. So that's why I have the neutral on here. And then we have bearish type of positions. I'm going to end with this before we go to the wheel. I'm going to ask everybody a question. Those of you that know my style of trading, you've been around for a while. If vol is really cheap, or when it's really cheap, okay, what's kind of my go-to strategy when vol is really cheap? Okay, got the wheel ready to go here as soon as I get some answers on this. Okay, a debit, long spread, buy protection. Yes, I like buying protection. That's for sure. I love buying time. When volatility is cheap, I want to buy time. Remember, further you go out in time, the more expensive an option is. But if vol is cheap, okay, then that option is going to cost me less. And the likelihood is, and when I say cheap again, I'm looking at that implied volatility chart. Okay. The likelihood is it's going to start ticking up. Well, if I'm able to buy volatility cheap and it starts going up, that VEGA tells me how much that change in that option is going to be. So when vol is cheap, I want to buy time. What are some buying time strategies? Time spreads, calendar spreads, diagonal spreads. Those are my go-tos, specifically when vol is cheap. Okay, calendar spreads are phenomenal. Diagonal spreads, which are the same as calendars, just using a different strike. Buying time. If I buy time, I am buying VEGA. Remember, VEGA is higher the further expiration I go out. So if I sell an option that expires in 2 weeks, but if I buy that, same strike option or even, one off or two off, make it a diagonal, that's out 4 weeks or 6 weeks. That option I'm buying has higher VEGA to it. I'm playing the probabilities because vol was cheap, that vol is going to start ticking up and benefit the position. Does that make sense to everybody? Okay. Now, yeah, Bill, I like that. Could buying time be a market minds topic? I'm going to put that into my chat right here. Buying time a topic. Yes, absolutely. Thank you for the suggestion. Okay, before I spin the wheel, I'm going to ask you guys very, very nicely again to please smash that like button. Help us out. Okay. I love doing this. And I hope you guys all find it useful, but we got to get more people in here. Like and subscribe. That is correct. Okay, yesterday's winners. Hang on. Yesterday's winners were Rick, Huffmeyer, and Nico. So if you guys are up on the wheel today, and I'm getting dizzy just looking at it right now, you can't win this week again. Okay, it's just something that we, put in. So you, unlike Robert D, who, you know, had the luck with him and won like 4 out of 5 days. So if your name comes up, hey, best of luck, but we're going to spin again. All right. Here we go, everybody. Let's do it. Today's winner. Oh, just past Nico. Anthony or Craig? Anthony or Craig? Anthony, Craig, it is. Robert's Rules of Order. Yeah. Okay. Anthony or Craig, are you here? Are you in the house, Craig? Oh, you gotta be in it to win it. There we go, Craig. Awesome. Awesome, awesome, awesome. Still trying to figure out how on this new platform we're using, how the hell I can chat with everybody. Chat with everyone in the studio. Let's see if this works. Hang on. Okay. Did that come through? I just chatted email address. I don't know if that went through or not. That may have just been to, oh, there we go. I think it did. Boom. All right, Craig, shoot me an email. Mailing address, size swag. Thank you for the suggestion. I will take these suggestions every day, guys, on what topic we want to talk about next. Okay, just as a little PSA, public service announcement, we will not be doing Market Minds Thursday because the markets are closed Thursday for National Day of Mourning in observance for President Jimmy Carter. So we will not be doing Market Minds on Thursday, but we will be back live tomorrow. Okay, now I saw a request for a copy of this. I will put a link up here tomorrow. Okay, I will put a link up here tomorrow for everyone to grab this. Or you can take a screenshot of it right now, but I will put a link up here. Okay? Thank you, everybody. Appreciate it. Appreciate you. Have a great rest of your trading day. See you tomorrow.